Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, March 29th, 2024. Another important piece of the disinflation narrative was put in place today when the Bureau of Economic Analysis released the Personal Consumption Expenditures, or PCE, price index numbers for February. Last month, core PCE, which excludes food and energy, rose 0.3% and was up 2.8% over the past 12 months. That is less than the January figures of 0.5% and 2.9% respectively. So what I'm showing you here is the press release from the Bureau of Economic Analysis. Now you'll notice the February 2024 number says plus 2.5%. That includes food and energy, but since those prices are so volatile and not necessarily indicative of long-term trends in inflation, they also report it without. So if we go down here and go to the current release and we look at the chart, you'll see as we look down this far right-hand column for February, PCE, both including and excluding food and energy, was up 0.3% in February, and over the past 12 months grew 2.8% excluding food and energy, and was actually up less than that, only 2.5% including food and energy. Now afterwards, Fed Chair Jerome Powell said those numbers are not as low as most of the good readings we got in the second half of last year, but it's definitely more along the lines of what we want to see. Now that's important since the PCE index is the Fed's preferred measure of inflation and has more influence over its decisions regarding monetary policy than does the consumer price index. However, Powell also cautioned, we expect inflation to come down on a sometimes bumpy path to 2%. But if that doesn't happen, then obviously our rate policy will be different. Powell went on to note that given the strength of the economy and the jobs market, we can wait and become more confident that in fact inflation is coming down to 2% on a sustainable basis before cutting interest rates. So, is that mixed messaging good news or bad news for the stock market? On the one hand, Powell did not say that today's report was unexpected or unwelcome. On the other hand, he qualified his remarks to give him wiggle room later on if the Fed decides to keep interest rates where they are longer than Wall Street would like. And that's why all the major stock market indexes were flat today. 30 minutes before today's close, the S&P 500 index was up 0.1%, while the NASDAQ Composite Index was down by a similar amount. That's okay given the strong start to the year that has seen both indexes rise about 10% over the past 3 months. Another 3 quarters like that would make 2024 one of the best years ever for the stock market. Now here's a year-to-date chart of the stock market, and you can see just steadily rising with a few little blips along the way. If you look at just though the past 5 days, even though this looks like a big jump relative to where it was earlier in the week, again, if you go back out to the year-to-date, you can see way over here on the right that it's barely an increase at all. Nevertheless, it's not a drop, and it allows this year to end, or the first quarter rather this year, to end really on a very solid note. Of course, no one really expects another 3 quarters like the first one to happen over the remainder of this year. A more likely scenario is for the stock market to flatten out at some point this year and perhaps go through a retrenchment phase if the Fed leaves interest rates unchanged throughout the second quarter. At some point, Wall Street will demand rate cuts to justify the extent to which stock market valuations have risen over the past 5 months in anticipation of lower rates. Now that brings to mind the taper tantrum of 2013, when bond yields spiked after the Fed announced that it would begin tapering its quantitative easing program. The Fed had acquired a massive portfolio of bonds in the aftermath of the Great Recession 4 years earlier and decided it was time to start selling those bonds to reduce the size of its balance sheet. Now I'm going to show you here the 10-year Treasury note yield, and I'm going back to basically 2008 through 2014. And of course, over here on the left, you see this big drop here, and that's when the Fed had to cut rates when the stock market crashed and the real estate market crashed, and everything was falling apart. Not just here, but all around the world. This was happening in Europe and other parts of the world as well. So the Fed started buying up bonds, that's what quantitative easing is, that effectively kept yields low. Now we come out here to 2013, and you see way over here on the right, this rise in rates. At that time, the 10-year Treasury note yield was, around 1.5%, 1.6%. It very quickly ran up to almost 3%. But as it turned out, the taper tantrum was unwarranted. The economy held up and the stock market did not crash. If we do get a rerun of the taper tantrum later this year, I view that as a buying opportunity instead of a reason to sell stocks. And that's this week's PF update. I look forward to talking to you in another week. Thank you.